So you look at your payslip, you see that little line item for income tax, and you just kind of wonder, where is all that money going? And more importantly, am I doing this right? Well, in the next few minutes, we're going to break down the Indian income tax system. Super simple so you can actually understand it. Let's dive in.
Right? It's the big one. It's a question we've all asked ourselves. Every single time that chunk of your hard-earned salary just vanishes, you've probably thought, seriously, why? And you know what? It's a totally fair question. And the answer is actually pretty straightforward.
Think about it this way. Taxes are kind of like your subscription fee for being part of a functioning country. That money is what the government uses to fund everything: our national defense, the roads and bridges we use every day, public schools, hospitals, the whole shebang. So, really, the tax we pay is a direct investment in the community we all live in. Okay, so the government doesn't just collect tax in one way. There are actually two main buckets, which brings us to the first big thing you need to get: the difference between direct and indirect tax.
So what's the big difference? It all comes down to who actually foots the bill. A direct tax, like your income tax, is paid directly by you. You earn the money, you pay the tax on it. Simple. You can't pass that burden on to someone else. But an indirect tax, like GST you see on a movie ticket or a dinner bill, the business collects it from you, the consumer, and then pays it to the government. See the difference? Your income tax is your personal, direct contribution.
So, where do all these rules and regulations actually come from? Well, it's not like there's one giant rule book of taxes. The income tax law in India is actually a whole system built from a few different key parts that all work together. The bedrock, the foundation, is the Income Tax Act from way back in 1961. But, and this is a big but, it's not set in stone. Every year, the budget introduces the Finance Act, which can change things up. Then you have rules, circulars, and even court decisions that clarify how everything works. The main thing to remember is this: tax law is alive, it's always evolving. All right, let's get into the nitty-gritty. How do we go from the total salary you see on your offer letter to the final actual amount that the government taxes? It's a step-by-step process, kind of like refining something down to its purest form. I want you to picture a funnel. At the top, you pour in all your income from everywhere: your salary, any rent you get, maybe some capital gains. Then, as it goes down, you combine things, adjust for any losses, and you get what's called your gross total income, or GTI. Now, here's the crucial part. From that GTI, you get to subtract all your eligible deductions. And what drips out at the very bottom of the funnel is your total taxable income. That is the magic number. And that brings us to what is, honestly, the most important decision you're going to make about your taxes today. You have to pick between two totally different ways of calculating your tax, two regimes. And believe me, your choice is going to directly impact your wallet. Yeah, this whole choice thing is pretty new. It kicked in around 2020. And understanding these two paths is probably the single most powerful thing you can do to manage your taxes effectively right now. You absolutely have to know which one works better for you. Okay, so here's the trade-off in a nutshell. The default, or new regime, gives you lower tax rates. Sounds great, right? But the catch is, you have to give up almost all your deductions, things like HRA, LTA, and many common investments. The optional, or old regime, has higher tax rates, but it lets you keep all those juicy deductions to shrink your taxable income. So the question you have to ask yourself is, do I want the simplicity of lower rates, or do I have enough deductions to make the higher rates worth it? Let's look at the default regime first. The big headline here: you pay zero tax up to 3 lakh rupees. After that, you can see the rates climb up pretty gently. The appeal is obvious. It's simple, it's straightforward, and hey, if you don't have a lot of deductions to claim anyway, these lower rates could definitely work in your favor. Now compare that to the optional, or old regime. Right away, you see the tax-free limit is lower, a 2.5 lakh. And whoa, look at that jump, from 5% straight to 20%. At first glance, this looks way worse. But here's the secret sauce: deductions. If you have a big home loan, or you've maxed out your tax-saving investments, you can lower your taxable income so much that you actually end up paying less tax overall, despite these higher rates. But hold on, we're not quite done. No matter which regime you choose, there's one last little step. On top of whatever income tax you've calculated, the government adds a 4% health and education cess. This isn't on your income, it's an extra charge on your final tax amount, and yep, it applies to everyone. And that brings us right back to the million-dollar question. Which regime is the right one for you? Honestly, there's no single right answer for everyone. It comes down to your personal financial life. If you've got that big home loan, tons of investments, and other major deductions, the old regime could save you a bundle. But if you like to keep things simple or don't have many deductions, the lower rates of the new default regime might be your best bet. The only way to know for sure is to do the math. You have to calculate your tax under both. So, what are your numbers?